right. Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into a live episode of the podcast. We're going to do some live today. And I have a very, very special guest on the line, Mr. James Foytlin, that you guys are very, very familiar with if you tune into the show. As people coming in live, you can drop live questions. But I have James here all the way from New York City. Well, not New York City, but, New York City by the way of New Jersey. But we're going to jump straight into it. How you doing today, James?
I am doing good. We're, like I said earlier, we're a little cold out here today.
Oh, it's a little cold out?
Yeah.
Okay. Well, as everybody can see, the topic today, we're going to be talking about are we headed to a recession, right? So the first thing we want to talk about is, we just had a jobs report come out. Unemployment rate didn't change, but we saw it, it was a little disappointed with the number of new job creations. We did see a little bit of we've been in a bull run since 2009. We also have seen a little slowdown in manufacturing activity. Question is, James, are we headed to a recession? What do you think?
Oh boy. Well, I start out preference this way. For 2 years we heard Russia, Russia, Russia. Now we heard recession, recession, recession. The whole time we should have heard China, 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 because that's what it's really all about. And I don't buy the recession talk at all. I don't really see anything that would suggest we're going into a recession right now.
Okay, we got James. We got a comment that said somebody said that the J. Hip said the market was flat today. It was flat. I thought it was going to be a down day due to the jobs report, but it wasn't great jobs report, but it wasn't bad as well. But go ahead, right. James. You're saying the conversation should have been on China. Why is that? Why are we so volatile?
Well, if you look today, Powell made a big statement, and Powell came out and said, look, the Fed is not forecasting a recession. The big issue right now hanging over everybody's head is trade policy with China. And if there's any slowdown anywhere, it's because of the uncertainty of the trade negotiations. And that's what I've been saying for really like almost 2 years. What I'm finding kind of funny is you have people like some of the analysts from the Wall Street firms have been already saying we were in a recession for 2 years. Mm-hmm. And I can just from my own little personal businesses, I run a couple of small businesses and they've had enormous increases in revenue in the last 2 years. It's like mind-boggling.
Well, Jay, let me answer this question, right? Jay said Powell said today he doesn't see a recession and that the statement kind of nullified the market. But if he doesn't see a recession, why is he cutting interest rates? Why did he cut interest? Why did he drop interest rates, which is a signal of a sign of like, hey, you want to stimulate the economy. Why did he cut the interest rates?
Well, I think the problem with Powell right now is they're dealing with a massive amount of debt on the debt side. And I just think that they're trying to kind of manage that debt bubble so it doesn't get so large. We're still dealing with a lot of the aftershocks from 2008. Mm-hmm. And I still think there's a lot of cleanup out there, far more than most of us are aware of. And I think when you look at the student loan debt, you look at a lot of other numbers like that, they're kind of ominous looking. For me, I think, I'd rather see the Fed I also think there's a big undercurrent argument going on right now that several central bankers are pushing the idea of going back to a fixed currency regime and moving away from floating currencies. And a lot of people are basically saying this floating currency thing has failed. And we need to peg our currency either to gold or some kind of cryptocurrency or something like that. And that's what needs to happen.
Well, let me ask you this question then. Explain out there to the listeners and the people that catch the playback, what is a floating currency?
Well, what we have now is we have a system. After World War II, we had something known as the Bretton Woods Agreement. Bretton Woods, I think I'm saying it right. And what it basically did is it created a regime with the currencies where, the dollar was worth this to gold and traded within a band of, from this to this. And the British pound was worth that to that. And they were all kind of linked in basically to a somewhat of a gold standard. Basically what was really going on is the dollar was kind of linked to gold and the rest of the currencies were linked to the dollar. In the early 70s, while President Nixon was around, that whole thing kind of blew up. And Nixon basically took us off any link to the gold standard. And with encouragement for some very famous economists, said, let the money float and go where it is. And what that's done over basically the value of our money is determined right now by trading that money in all those big currency trading, all the companies, all the banks that trade currencies. So if Trump says something crazy today, the dollar may get pushed down against, say, the Chinese yuan. If we look like we're going to negotiate more and trade talks go well, maybe the dollar will rally. And basically, that's all created because people are buying and selling those currencies, just like they're trading stocks.
Okay.
And I would posit that one of the reasons the middle class has suffered so greatly since the 70s is because the money basically, what you've basically done is the money's become political. And so governments who maybe have too many debts or too much debt outstanding, they can kind of inflate their way out of that debt.
So, will you say by the end of this year, you think that this year will be a bullish year for the most part, or you think we're going to see a big sell-off?
Oh, definitely. I think that I think this year has been a learning. If you haven't learned one thing this year, you should learn to buy on the dips. That every time they run around and go, the world is coming to an end tomorrow, and you should be buying like crazy. And when, and maybe some of you want to trade a lot, you might even want to sell into these big rallies, like not today, but maybe yesterday when the market was up really, was up pretty large. I guess either yesterday or the day before, we had almost like a 400-point day. And you might want to look to those rallies to get out if you're skittish, but I just think you got to use all the weakness to buy. And I think there's a pretty compelling case to buy equities right now. There's a bunch of things that have happened over the last 10 years, and there's also something we never talk about, which is the enormous cash balances that some companies and some countries have.
And you know what? I always tell people, my rule of thumb is if the market goes down, the Dow Jones in particular, if it hits about 500 points in one particular day, over a couple of days, if it falls, like one day it falls 200, next day it sinks 300, 400, that always signals a buy day for me. So I tell everybody that follows me or whatnot, buy the dips, take advantage of the dips. And I don't try to sell off on a rally. If I want to get a little crazy, when the market hit an all-time high, I may get some bearish, leverage ETFs, or when it's at a low, I may get some bullish, but that's if I want to get a little crazy. But just for simplistic versions, I don't buy anything unless the market is like down 500, 600 points in a day. Unless it's some type of fears running rampant, that's the days I look to buy.
Mm-hmm. And look, even like JP Morgan was forced to start to recommend people buy on the dips. On September 3rd, they came out and they flipped around because a lot of these big brokerage houses have kind of been they've been beating their drums with all this recession stuff because they're just looking at, really the overall picture of China. And the ugly reality of trade wars with China is that right now, China is getting creamed. And the American media doesn't want to admit it. Trump is winning this thing like hands down. I mean, China had the slowest growth they've had in 27 years. Some people even argue 30 on their GDP. They have a lot of internal debt. They have a lot of internal issues, and they're under a huge amount of pressure right now because as the economy slows down, this is a huge economy with, with 1 billion people. and 1 billion people all need to go out and buy shoes. And it's like any little slowdown the level of growth rate that economy needs just to provide like basic minimal services to people is significantly high.
Yes, and that's true.
And
Well, one of the things I look at too is I really think that the psychological mindset is that, we've been in a bull market since 2009, and everybody is looking for, hey, what's going to trigger the next recession? When is it going to come down? When is it going to come down? And anytime we see any type of inkling of weakness and data or anything, let unemployment go up by, a margin. Everybody's going to flip out because everybody is looking for, when is that recession coming? When is the recession company coming?
yep.
It's just like, hey, it's like that rainy day. Hey, it hasn't rained in a long time. I know the rain is coming. So as soon as we get any hint of rain may possibly coming, everybody just sells. Oh, is that a cloud or whatever the case may be? So it brings in a lot of fear in the market that I believe. A lot of fear.
Yep.
It brings a lot of fears because everybody's living on edge. And I think by people living in the fear, it brings opportunity to long-term bullish investors.
Yes, we used to call that the wall of worry. And that, to me, as a long-term investor, is very bullish. I want to see people worried. I want to know that Morgan Stanley doesn't really want us to buy stocks, because then I'm going to buy stocks. I want to know that Buffett is sitting around going, well, the market's kind of overvalued. I can't figure out anything to spend all my money on. That's what I want to hear. I don't want anybody out there going, the market can only go up and it's going to keep going higher. And then I get real nervous.
That's weird. So you like fear in the market because you think fear brings a undervalued market, is what I'm hearing?
Well, I think that as we work our way through some of the economic and structural changes we're going to see, I think we're at one of those pivot points in history. And I think there's going to be a lot of big changes in the next 4 or 5 years, maybe similar to like the early 90s when the internet broke loose and cell phones became popular everywhere. I think you're going to see a lot of big changes. I think the economy itself is going to undergo a metamorphosis. I think there's a lot of stuff going on. I think that the era of sort of big government is long over with, and people just haven't recognized it yet. But I know that's not a politically correct thing to say nowadays, but I think the writing is long on the wall for big. I mean, if you see Brexit, if you see all the other issues going on with size, it becomes readily obvious to most people that a lot of this stuff just isn't quite working right. And then when I look, now I want to get back to this cash thing 1 minute, because I think a lot of your listeners don't know about this. For example, 2 days ago, Japan and a bunch of Japanese banks came out and basically announced that Japan has the largest cash on the sidelines they've ever had. Japan currently claims that there is $4.8 trillion sitting in checking accounts of big companies in Japan looking to be put to work. Apple Computer, a lot of people, you probably have a lot of Apple buyers out there who listen to your show. Apple has a well-publicized $200 billion, like basically in their checking account. And Warren Buffett said yesterday he's up to $122 billion himself.
You know what? That was the crazy.
Just,
that was one of the things when I was up at Berkshire a couple months ago. That was one of the things that he said was, hey, I really have about 100, I think his stock portfolio is like 250 billion, and he's all these other things. But he said, hey, I got like 150 billion, 120 something billion or whatever, just sitting in a checking account. I'm like, that's crazy. But I don't know if he's waiting on the next recession, but he just says that they haven't found anything attractive enough. They would love to make a big buy. They would love to do something, but they haven't found anything that was right, that was attractive enough.
Now, also think of this. Now, pair that what I just told you. Think of, since Sarbanes-Oxley was passed after about, 2002 or something, after Enron went bankrupt. And a lot of people would argue that Sarbanes-Oxley might have been the cause of the 2008 financial crisis, which I think a lot of Sarbanes-Oxley led to the 2008 financial crisis. That was like the last big prior to 2008, that was the last big government sort of huge change in financial regulation. And one of the things that Sarbanes-Oxley did is it suppressed the amount of initial public offerings. What you're seeing a lot in Silicon Valley now is a lot of companies are staying private for a very long time and becoming multi-billion-dollar companies before eventually they go public. Now,
let me ask you this question, Jane. Why do you
right.
think these companies are sitting on so much money and cash? They wait on the next market crash. They think the market is overvalued. What do you think the thought process behind companies sitting on a load of cash?
Well, I think I think one of the things is a lot of the traditional stuff that people have been buying. I mean, if you remember the movie, the book or the movie, The Big Short, you talk about 2008, there was a guy mentioned Mike Burry. Mike Burry was one of the first guys to short CEOs, or at least one of the first guys that people know about. And Mike Burry came out a couple of weeks ago and said, we got to use, the biggest problem is everybody's been putting money in index funds, which basically buy the same 100 stocks over and over and over again, and money hasn't gone anywhere else. So you might have a certain segment of the market that's way overvalued, but nothing new has emerged to take leadership, and that's what I'm talking about. This huge change. Like, I just think the days where you can buy Apple, Google, Facebook, and what's the other thing that everybody buys?
Hold on here. Okay, we got a comment in the chat room. Somebody said, "Buy gold, please." Because what are your thoughts on gold?
What's interesting about gold is performing very well. I think the charts look really well. If you follow GLD, which is one of the exchange traded funds that is gold, that kind of is interesting. But some of the smaller gold stocks have performed like even better, like Barrick Gold or stuff like that is way outperformed the price of gold. And I don't know. I think if we're going to get to this point where we might go on a fixed currency regime, I think gold may have a run before this happens.
Well, I think
because you need to cover a lot of currency with the amount of gold that's available in the world.
Well, I have this question. I'll put it to you this way. Let's look at gold, for example. Okay, it said buy gold and silver, right? But in the chat room. But the thing about gold and silver, what do you have to say to the people that says, hey, gold is kind of flatline. When market uncertainty comes, it spikes. When the market goes back up, it kind of flatlines again. And yes, gold has been going up, but when you compare it to the equities market, the S&P 500, and how stocks have been performing, it hasn't been outperforming the stocks. We're looking at, the S&P 500 so far this year is around about 15, 16, 20% versus gold, which is, kind of took a dump today. So what do you have to say to like, hey, well, why would I buy this gold? Yes, it will spike during the next market crash. We all know that. But in the meanwhile, let's say the person who brought gold back in 2010 and they held on to it for this long.
Well, if you look at like, say, just GLD, like, which is the sort of the gold spider, that was like 120 on May 28th, and even down quite a bit today. It's still 141, which is like an enormous move for a big index. And mind you, it has been kind of sleepy, range bound, probably for the prior couple of years before that. I think it didn't do a whole lot of anything for a while. It's only really made a move. I guess probably some people would probably say somewhere under 130 was a breakout point, and that's only been the second half of this year. And I just think there's a lot going on. Like, we may get our blockchain-based currency or some kind of gold-based currency a lot sooner than we all think. And I also think the internet itself is probably going to become more blockchain-based as opposed to sort of the way it is now, because we need right now the internet really is lacking security. It just you can't do anything anymore without getting spammed to death, or everybody's trying to catfish you every minute. that everything's a fake. Every website you go on, every single thing is fake. Like it's just
What somebody said?
becoming.
Well, what somebody said? Gold is up 25% this year. Let me fact check that. Let me fact check it.
Yeah, it could.
Let me once I
Yeah,
get my
that
phone.
could be. I'm looking at about the end of May. It took off, and
Okay.
I haven't done the calculations, but that's about. And it's made a noticeably large move. And if you look at some other things like Barrick Gold, like if you look at what is it, GOLD, which is the symbol, I think, for Barrick.
Mm-hmm. Yeah, I know those individual gold stocks have been going pretty great, you know. But
Right.
but the like the
And I
GLD
just think
gold
this
index
is
altogether.
what we need. It's just like Bitcoin, like going up in value. Why would Bitcoin go up in value? Because in essence, if it was going to be sort of the backing for currency, there's not enough Bitcoin to go around for the size of the volume of actual currency that's available out there now.
Mm-hmm.
Like if you look at the float of you take all the money in the world, what is it, like 12 trillion or something, some enormous amount of money. There's not enough Bitcoin, there's not enough gold to cover that right now.
Mm-hmm.
So if we go to some kind of fixed exchange rate, gold is going to need to cover that. So that means it's going to go up a lot. And
Okay.
I just think that we may see a time where I just think some really big changes are coming. And I think some of the weirdness about this market, this volatility, things trading oddly, like gold and like usually you'd say, like your commenter said, gold, it has sort of an inverse relationship. The market goes down, gold goes up. The market goes up, gold goes down. But that hasn't necessarily been true this year.
Mm-hmm.
The market, gold has kind of been trending up pretty much regardless of what happened lately. Like I said, since the end of May, it's basically been trending up.
Yeah,
the market has been kind of volatile. Like the S&P's been up and down, up and down, up and down.
I got 24.2. So he was right. It's about 25%. Gold is up this year. Gold overall to now, I had a GLD up about 25% due to my quick calculation. So he is right. You know, so gold.
Yeah.
So you say gold is you know, I think GLD plays a nice little dividend as well. And you could buy the real gold. I don't know about buying. The only thing I have about buying like actual blocks of gold is the marketability of, like, you know, if I want to go sell this, I don't want to have to walk down to a bank or put my gold in a mailbox. I don't like the marketability of trying to liquidate my gold block.
Right. Plus, you have to store it and guard it somewhere.
Exactly. I don't want somebody to say, "Oh, Prince got gold." Okay, you know, and next thing you know, my house is raided. So, but now
because they all listen to your podcast and they know as soon as you went on vacation, they'd be showing up there.
Okay.
You know what goes. Like, look, you're talking to a New Yorker here. This is the kind of stuff we think about all the time.
Yes, somebody just asked me, "Am I live on my podcast?" No, we're live on YouTube right now, but this will be replayed onto the podcast. So for everybody that's it will be replayed onto the YouTube and stuff like that.
If you look at Barrick Gold, GOLD, it was like what? It was 1196, and again, May 20th, it got as high as 1938. I mean, that's even a bigger move. Percentage-wise, that's even a bigger gain. That's probably pushing 40-something%.
Mm-hmm.
And that's Barrick Gold. That's a huge gold company. But I don't want to tell people like run out and buy gold. I just think it's telling us something, and I think it's a really interesting. Because, I'm old enough to remember like that big run in the 70s when we came off the gold standard. Gold rallied huge. It just went up and up and up for them.
Well, what caused gold to rally after we went off of the gold standard? That don't make sense. I thought that. In the market.
Weird. I think because people thought people who were sensible thought the world was going to come to an end. So and if you lived through the 70s. I mean, I just finished reading the book, The Bronx is Burning. It's about 1977. And in 1977, New York almost went bankrupt, had a blackout, had riots. had two terrorist bombings by the FLAN, which was a Puerto Rican separatist group. Almost had like a short-term transit strike. It's just like the amount of things, that the amount of chaos in that 1 year is like mind-boggling. And I think that's why gold was up so much in the 70s, because you just had a whole decade like that. And I think, not that I'm thinking we're going to have all this chaos, I just think in a period of big change, people are going to shift to things that are really comfortable. And I don't think this is going to be a negative change. I think this is going to be really positive. I think this is it's going to be a big plus here.
Okay. Now, what do you have to say? Because I just looked at the S&P 500. I didn't calculate any dividends for the year. Right. I didn't do any. I don't even know if GLD plays dividends. But not looking at it, I had the index. I had gold outperforming the stock market by 1% or 2. And someone said,
right.
He said it's very easy to sell or put gold in a bank vault. The high inflation and the government stopped the price control that they used to have. Now, the thing is, for the people out there saying, man, I believe a recession is going to happen. If you knew a recession was going to happen in December, how would you prepare for it?
Oh, if I thought a recession was going to happen, I don't know. See, a lot depends. What I've learned over the years is, number one, recessions or crises or bubbles or all these things do not happen the day after they get announced in the New York Times. That never happens. They always kind of come out of the blue in some one-off oddball thing that no one is, like, everybody's looking one way and it comes from the total opposite direction.
Oh, yeah, you've been around. You've been around since the 70s.
Yeah, I would say 9/11 is the perfect way to think about that, because before 9/11, who in the world would think somebody would hijack 2 planes and crash them into office buildings like that? You basically, that's before that was out of the realm of possibility. Since then, it's always one of the factors that may be a distant factor, maybe a far-off distant factor, but nonetheless, it's in the probability. It's got to be in your risk parameters now.
And the reason I want to, James, I want to add on there, let the listeners know that you've been around since the 70s and the 80s and the 90s and the 2000s, and you've seen plenty of bull runs. You've seen a lot of bears. One of the things that I have as an investor. In 2008, I was very amateur. I think I just started buying mutual funds at that time, but I wasn't well versed into the market of what was going on. Can you explain to me, how does it feel when that bear or that recession comes? Is it kind of linger in, or it just boom hits you out of nowhere? How does it come?
It's usually it like we always say, stocks go up the elevator or up the stairs, or they go up the stairs and they come down the elevator, or I say it's like a waterfall. The downside is the velocity is much faster, much more severe. I think generally recessions kind of creep on you and hit you really hard. There has been a few, I think, like I sort of remember in like I don't know what, like the mid 90, like 94 or something, we had kind of like they called it like a creeping recession, where it just was really slow for a while, and then all of a sudden it got going again. Like 87, when the stock market crashed, it was brutal. Like you particularly if you were in the financial business, the layoffs came fast and furious. 2001 was kind of different because it was a big dislocation because of a terrorist attack. Like, there's just different, like, almost everyone is somewhat unique, somewhat different. Some happen because we have a crisis, like 2008, and basically the banks almost blow up, and basically the whole financial system almost closes down. But from the lending side, not from the financial side, not from the equity side, right? Mm-hmm. But other times you might have a recession because, like, I could sort of remember when Nixon was president, we got to a point like now where unemployment was really low. Everybody was working 2 jobs. And then all of a sudden, it just, like, when it can't get any better than this, it can only get worse. And then after about the first 2 years, from then on, it was like it was kind of chaos, or it just got the economy got weaker. And then you had all these chaotic things. You had oil shock. You had, you
So,
had
Jen, so,
hyperinflation.
so Jen, at that time, it was no feeling of like, hey, we're doing well, or right before that market crashed. Oh wait, I could understand 9/11, but right before '08 happened, like nobody kind of had the settlement of like, hey, maybe no recession talks were going around, no indicators, or it's just like boom, left
No,
hook.
usually you get to a point. Well, there's two different things: a recession or like a bubble in the market. And usually, if you have a bubble where there's massive over speculation, you get to a point where people start to say, "Hey, if I don't get involved in this, I'm losing money. I'm losing way too much money by not doing this." And when people make that mental jump, and all the speculators make that mental jump, that usually, it may not happen right away. It could happen a year later, but it's going to blow up like the tulip bulb bubble, or like the stock market crash in '29, or in '87. Or like in 2008, where the bank, like that CDO thing with all the lending, just kind of blew up and like basically went to zero. And
so you say
there are a lot of after the fact quarterbacks Monday morning who go, "Oh, I saw this coming," but I want to tell you, 2008, I read a lot of stuff, and nobody was talking about the CBOs were all going to blow up. Like, if they were, I must have totally missed it, because there was very little talk of a lot of the stuff that was going on, and I still read a lot of stuff where I just think there were a lot of people who were very intelligent who really were caught totally by surprise by the sort of the consequences of what went on before 2008,
now,
creating that
I want to ask this question:
mortgage bubble.
When the CDOs, the collateralized debt obligations, started to kind of blow up, that pretty much led into the '08 crash. When it kind of came out, hey, we got a CDO issue, did the market immediately react, or did it slowly went down, or was it just like
no?
boom?
Well, you know what was weird about the CDOs is CDOs were not traded in a secondary market. They were bought by insurance companies, pension funds, a lot of foreign banks, and basically people use them to what we used to call as coupon clippers. In other words, little old ladies used to buy bonds. They put them in a shoebox under their bed, and every quarter they'd rip a little coupon off the bond and go to the bank and turn it in and get their interest payment, and they live off that. And so a lot of huge insurance companies just use them to capture that yield, because they were mostly rated AAA, so they had a really high credit rating because they were mortgages. And then and they would buy them in lieu of government bonds. Now, the problem with 2008, unlike in the 1980s during the junk bond era, when you had the junk bond era, Milken invented this financing, basically this sort of no money down, and let's find some guy, a guy with a shoe store. We can raise enough money, and he's going to buy General Motors the next week. Like, Milken could do that.
Wow.
And I mean, I'm a little over exaggerating, but there was some enormous transactions that people made coming out of nowhere because he raised the money for them. But what Milken did is Milken created a secondary market. So those bonds not only were issued, they were actively traded, not only by Drexel, but then other people started trading them. And people would buy them in the secondary market and sell them. And sometimes if you bought some bonds from him and he said, "Look, Mike, I'm a great customer, but I'm not happy with these bonds," he might buy them back, and Drexel would take a loss just to make you whole. But that would come with a hook. And the hook was, when I call you next week with a new issue, you're going to be first in line to buy a whole bunch of it. And he created, now he also got in trouble for doing this, but he really created a very active market in those bonds. There was no active market in CDOs. So there was no way to gauge the price of these things.
So practically nobody knew this was coming. Nobody saw it.
Right. Goldman Sachs created all these like computer programs, and they said, well, you have a CDO, and 20% of the mortgages are in Southern California, 10% are in New Jersey, 10% are in Colorado, the rest are in Texas, Oklahoma, Alabama, and Arkansas. And with that probability, under the current market conditions, it means these bonds are worth 98 cents on a dollar. And that's how they took the price.
So,
and in 2006, there was a major blow up of a $1.4 billion CDO exploded, and basically the investors who bought this AAA rated bond got like 20 cents on a dollar. And that did shake up the market a little bit, but the market rebounded because none of those bonds were really actively traded, so it didn't really reflect. And there was so much, I guess, for lack of a better word, I'll just say greed because of the big commissions. People were believers. They're like, these are mortgages. They're never going to go out of business. People always pay their mortgage. People have always paid their mortgage. The real estate hasn't all gone down since the 1930s, since the Great Depression. And you know what? In 2008, all real estate went down all across the country.
And you know, and the thing about and that's why Goldman Sachs got in trouble, right? Because people were saying, "Hey."
Well, a lot of people got in trouble. I mean, this is one of the things you're seeing now. After 2008, the government came out with this thing called Dodd-Frank, which was kind of like the next Sarbanes-Oxley. And they had this huge overall banking regulation, all to protect us from ourselves. But at the end of the day, all it really did is put the U.S. taxpayer on the hook to bail out all these big banks all the time, and no banks are allowed to go out of business. Okay. So if a bank's not allowed to go out of business, they're also really not allowed to make any money either. So Dodd-Frank basically put everything in suspended animation. And while I've always been a harsh critic of it, I would have to say, if you really study the situation, I've read a lot about 2008, about the crisis, from different guys, like Hank Greenberg. I've read The Big Short. I've read The Colossal Failure of Common Sense. I've read a lot of books on the subject. One of the things that stands out is many people, including the New York Federal Reserve, really felt the whole banking system was at risk. And so what did they do? They adopted Dodd-Frank, because in reality, Dodd-Frank may not fix anything, but it wasn't going to let anything get any worse. And that's what they were most worried about, which is a really scary thought when you think about it.
Well, my question to that is, I want to rewind. You know, like I've been around in the investing world now since 2008, but it's mostly been, I saw the market crash and I saw it, rebound, but I wasn't there before when the crash was getting ready to come. So I don't know what that settlement felt like, what that was kind of going on.
It really, I'm telling you, first of all, it's way more optimistic. It's kind of contrary. It's like the opposite of what probably most. Like I said, the New York Times.
Okay. Jay, let me answer this question. I didn't mean to cut you off. So you're saying when the market get ready to come to cash, when the market get ready to crash, people are usually very optimistic in the market. So people are like, "Go market, yes, go."
Bullish. They're super bullish about the economy. They're super bullish about everything. They're outspending too much money. They're getting in too much debt. They're building tall buildings. They're doing all these. They're aggrandizing their ego. They're out buying $50,000 watches. They're doing all stuff. But you know what? I don't really see people doing that now. I see people.
Oh, wait, hold on a second. Somebody
I see people have money.
Somebody got a question for you, James. Somebody got a question for you. They said, please listen to Robert Shiller. He won a Nobel Peace Prize for economy.
Yeah, he's a clown. He's a negative. He's a negative Nelly. He's been a negative Nelly forever.
So let me finish.
Trump,
he said, look for Shiller's index. It says, look for Shiller's index. It should show that we're 30 times over the PE. So I'm thinking, they're saying it's overvalued. Help warning signs are a great way to indicate for a recession. I'm thinking they mean they're saying. And it says, ask him about John Templeton. Yes.
Templeton was a great, that expression, buy when there's blood in the street.
Yes.
He was a great believer in buying ultra value. But I'm a believer in you got to deal with the market you have. And well, you're not at a time where there's blood in the streets just yet, but it wasn't that far ago. And remember, after 2008, the market sold off a bunch of times, even though it slowly over the next 10 years fluttered up very slowly, maybe at 8 or 9% a year it averaged out. We had a couple of times the market sold all the way back down to almost where it started in 2008, all the way back to 6,000 or whatever it was, but that went all the way down. So that was maybe your that kind of point. But for a lot of your readers and listeners, I'd hate for them to sit around and wait for the next 10 years, because I know people who are waiting for the 29 crash to happen again, and they've been waiting for 50 years, and they even missed 87, because they didn't think it was bad enough.
Yeah, because I was thinking, you're right, because I knew a hedge fund manager that used to come to Berkshire all the time, and he was very bearish on the market, and his hedge fund went belly up because he was very bearish on the market, and probably since 2012 he was bearish on the market, and the market's been completely bullish, and it just ended up creaming him in the end. So that's one of the things I noticed too with waiting, because you got to factor in that opportunity cost. Some people are sitting on the sideline with buttloads of cash waiting for the next market, waiting for the next market crash.
Right.
What do you have to say to that person?
Remember, when a guy like Warren Buffett is sitting with 122 billion or whatever he's sitting with, 100 or whatever, for him, he needs to make a significant investment. In other words, he probably has to spend 100 billion for it to even make any difference whatsoever in his ability to make money. A guy like me, maybe I could buy 500 shares of a stock, and you know what? If we have a good couple of months, I will get that $50,000 watch. But Buffett, he needs to make a huge investment to make it. Apple's the same way. I'm sure they're sitting on that $200 billion, because they have they need to use that cash for some enormous thing that's going to sort of kick their company into a much higher gear, which with the volume sales they're doing, it's called like the law of large numbers. When it's easy to go up 20% a year on $200,000 when you're starting. When you get to $200 billion, it gets to be really hard to go up 20% a year. It's just, those numbers are gigantic.
Wow.
So I think I agree that there's probably a lot of stuff in the market that I think is overvalued. There definitely is. I have no doubt about that. And I also think the overconcentration in what I would call index stocks, like the Facebooks, the Googles, the Amazons,
the good old FANG stocks.
There's a way over concentration in those stocks. And yeah, they have great companies, but there's just way too much money chasing too few stocks. There's very little money in small cap stocks. There's very little money in medium small cap stocks. And there's very little in new IPOs that are small IPOs that are coming out. This isn't like early 90s. In early 90s, you had IPO after IPO after. Some of these companies were companies like Akamai were one guy when they went public.
Wow.
They turned into a much bigger company, but a lot of these companies, Netscape was, I don't even know if they even had 100 people. It would have been a lot. They were tiny companies at the beginning.
Yeah, somebody said they said Warren Buffett
was tiny.
They said Warren Buffett stopped buying in 2014. Now he brought he made a pretty big investment into Amazon last year, and not a big investment. It was like 500 million. And I think he did another 500 million this year.
So the guy who's talking about buying more value, why in the world did Buffett buy Amazon? You could hardly think that's a value stock.
Yeah.
He uses this thing called enterprise value, and I could understand why Amazon would be very appealing. But there's no way that's like a bargain. You're not buying a bargain at that. Maybe in 50 years it will look like a bargain, but for most of us, that's not a bargain.
Yeah, it's like $1,800.
It may be a good stock to buy, but it's not cheap.
Yeah. The average person probably get maybe 1 or 2 shares. That's about it, if that.
Right, and on top of that, it's not very efficient for a small investor to buy that, because if you can't buy at least 100 shares, you're going to be, the stock really has to make a huge move to make any difference.
That's
it
true.
doesn't, it doesn't really do anything. So, so I don't know. I would say that, yeah, I mean, your listeners ask a lot of great questions, and those are super valid questions. But my view on a lot of this is all the negativity in the media and the bias and negativity of the media that even translated into a lot of the financial press is just as biased and just as negative. I just think that's the investors. That's the best thing we have in our pocket right now. There's so much negativity out there all the time, harping about everything. All this kind of fear that, like it hasn't been bad in a while. So it's like, the end of the world is just around the corner. And it's played in popular fiction, in movies. We make all these movies about the end of the world, all these TV shows about the end of the world. We're all going to die. I mean, a lot of the global warming people are telling us in 12 years, or now is it 11 years? I can't keep track. That we're all going to die. The world's going to come to an end.
Yeah.
I still remember in the late 90s that the world was going to come to an end in 10 years, and like somehow we survived. But there's a lot of negativity out there, and there's a lot of people making money off being negative. And all those bears that you hear, those big negative guys, they're going to say the same thing for the next 20 years. And when they are finally right, then they're going to broadcast it all over the world about how they finally called the next big recession. Well, they were calling it like for 10 years. In the meantime, stocks went up huge.
Yeah, I've seen some guys who've been bears for about 2013. Since 2013, they've been bears for the last 6 years, and they're turning around saying, of course the market will contract and we will go into recession, but then they go off and say, hey, look, I'm a genius. I knew this was coming 8 years ago, and it's like saying like, hey, it's gonna rain.
I have people who bought into that whole thing, like when Trump gets elected, the market's going to crash, and they sold all their stocks.
Wow.
And like they still never bought anything, and I'm like, you really believe a guy like Krugman? Krugman has never been right about anything, and he also won the Nobel Prize. By the way, so did Hitler. So it's not really. I'm not really sure a Nobel Prize or anything is any kind of is probably the opposite. You probably want to flag those people and keep an eye on them. It's more like
wow.
It doesn't really. It's kind of an odd thing, but it never seems. It's like in the old days when magazines were more important. If you became Time magazine's cover, like on the Man of the Year on the cover, you would immediately the next year you would have all kinds of problems. It seems to be like human nature or something. So I think when people get these big awards, they just can't deal and they go crazy or something. But Krugman in particular is like always wrong, even though he brags that he's right all the time. He's always wrong about everything. And he was the one who was like, the market's going to crash when Trump's going to elect him. Well, it wasn't even close. The market's really rallied. Yeah, it's been more volatile than it was under President Obama. Well, Trump is a much more volatile person. And also there's a lot of stuff going on now that you need to be volatile. It's there's a lot of big changes that just need to be done.
Okay. Well, James, we got to get up here and wrap out this show. But before we go, what you want to leave the listeners with? Right now, what are you doing right now if you're an investor? You just sitting back buying the same old index, waiting on the market crash?
No matter who you are, I would not be one of those guys who sits around forever waiting for the perfect asset valuations. I just think you're going to, like, for example, if you bought stocks in 82, yeah, the market crashed in 87, but you could have made a lot of money in those 5 years. I mean, because I can tell you, I made a lot of money in those 5 years.
Wow.
Right? And yeah, we got a little beat up on the crash, no joke, but we still made a lot of money. So
now, let me ask
just sat around that whole time.
Well, let me ask you this question. The person who's sitting on, I got a buddy that's sitting on like, I don't know, 400,000 in cash, young man. And, he's saying, hey, man, the next market crash, if it crashes next year, this year, I'm throwing everything in it. And you're telling that person to get off the sidelines. How would you tell them to get in, to get into the game?
I would say, like you would probably tell him, he should average in over time. He should use all these setbacks in the market to take advantage. He has a lot of cash. He doesn't have to spend all at once. The chances of him calling the bottom are probably close to zero. I mean, guys like Buffett will tell you if they get within 20% of the bottom, that's really good. And if they can do that on a regular basis, that's amazing. Believe me, almost nobody's going to get the bottom. A couple of times in my life where I really got close, almost hit the bottom down, it was more by luck than anything. And there was many other times where I missed it, or either I waited too long and the stock just got away from me, or something even worse happened. Like I thought it was the bottom of the stock, it just went on zero.
Wow. So you're saying trying to get that bottom is
off the floor, and it did.
And so you're saying pretty much trying to catch that bottom is pretty much practically impossible.
Yeah, I think he'd be better. Like when you have these big, terrible sells, I mean, we've had plenty of them. We had 700 points down like a week ago, right?
Yeah,
that would have been a time. I wouldn't spend the whole 400,000 in one shot. I wouldn't do that. But he should get average in, and especially if he's a young guy, he's got a long life. And I can almost bet by the time we get through this very troubled period that we're in right now, when things get kicking and everything's firing on all cylinders, you're going to see a lot. I mean, there's just a lot of stuff that's got to happen. I mean, there's so many things right now that need to be lined up and fixed, or people start to work in the right direction. There's just so much stuff now. Like people have debts for college degrees that don't do anything. They don't have the right skills for the jobs. There's like a skills gap. There's a debt gap. There's a lot of money, like a lot of cream is going to the top because profits seem to be made in this kind of economy where companies like Apple that dominate the market are just making a lot more money and nobody else can make any money in that particular niche. There's a lot of things going on now that are probably going to change. It's not going to stay that way forever. And if your friend takes advantage of all these big sell-offs, yeah, who knows? Maybe next week the market's going to go down 10,000 points. I doubt it, but like if you look at 87, if you look at the market now, saying 26,000 is your thing, to match 87, we would have had to be down like almost 9,000 points in one day. And we're crying about 700 or 800. 800 at this kind of market is nothing.
Wow.
And yeah, I mean, and I think if we start having IPOs again, if that spout gets turned on, which I think is going to happen probably in the second term of the Trump administration, I think you're going to see a lot more IPOs. And if that starts bubbling up, I think the market is going to go crazy. I think we're going to have another Super Bowl market again. It's going to hit it. Okay. I think you're going to be shocked now. Remember, at 82, by 87, the market had actually tripled in 5 years.
Wow.
It went from almost tripled. It went from 1,000 to 2,700 in 5 years. Amazing. So imagine a market at 26,000 that almost triples.
Okay.
I can't even count that high.
Well, that's good. That's good knowledge because you bring in a different aspect of, people talk about, it's like when something I see when people talk about Berkshire or Buffett or whatever the case may be. And I read a lot of books and I've read a lot of books on Buffett and Berkshire and whatnot. But those things are kind of null and void because, when you're actually there, you get firsthand experience. It's way better than the secondhand I heard or somebody tells me. It's like, no.
I think what I would recommend for a lot of your people, like a lot of people who listen to you, how I learn the most is from all the mistakes I made.
Exactly.
And if you don't want to make those mistakes, then what you do is you read about all the crises. You read The Big Short. You read about long-term capital in 1998 when they almost went under. You read about the stock market crash in 87 about the program trade. You read about the 29 crash. You read about these crises. You read about Enron. You read about what was that fraud, that Thermos, which was like the blood testing company that just went under in Silicon Valley. That was like a huge scam. You read about those things, and it gives you you really learn a lot about the industry and about the market and how markets react. and about sort of the blindness that sort of fear and greed thing goes on. First it's all greed, then it's all fear, and then and usually it's the reality is somewhere in the middle. And I just think a lot of people, like, you should always ask somebody, like, I always get this, people go, what's the stock you make the most money on? What they should ask me is, what's the stock you lost the most money on? Or what was the worst trade you ever made? Or what was the first time you lost a lot of money? And what was the first time you cried when you made a trade? And
you know what, James, and that's why I always hold myself. And when we met on Wall Street, I always wanted to be in contact with you and kept in contact with you because you was there on Wall Street in 2008. You was there in 2000. All of the market crashes, 87. You seen all these things. You was around. No matter how much I can read, is one thing. No matter how much I can learn, but if I can get next to somebody's experience, I can never replace that. I can read, I have a bookshelf full of ton of books over here. I read a ton of things, but it's a different story when somebody has experienced it, because you can forget what you learned, but you will never forget what you experienced.
Right, that's true, but I think the problem is that there's so many of these things now. Obviously, I might have a lot more experience than some of your listeners. And so if they read about long-term capital, they may not understand it as much maybe as I do, or because I was in the business, so I kind of get certain things. But I still think that those things, like just the kind of questions you're asking me, like how did people act before the market crash? How did people act before, they thought long-term capital was going to take over the whole world.
Wow.
And Jim Cramer was, a month before Bear Stearns went to zero, was screaming, standing on his desk saying, Bear Stearns will never go out of business. And that's what happens in a bubble. That's what happens in a recession. That's what usually there's this sort of unfounded, insane optimism, almost like a braggadocious like optimism. And any question of this gets like attacked, and I just think with all the negativity, we're just nowhere near any of that. People are just every little thing, people are freaked. And you know what? All those people who sold all their stocks in 2016 because they thought it was the end of the world because Trump got elected, eventually they're going to buy stocks again someday.
Wow, that's true. All right. Well, people are, people are up and down in the chats I see, and we've done some been great conversation. People will catch this on a playback. I know we had a good bit of people that's in here live, that's catching it live, and we appreciate that. But we got to get out of here. I know it's late on the East Coast out there on the East Coast, but James, as always, it's a pleasure to have you on, and it's always good to hear your intelligence. To hear, you seen these people, you watch these people, you was in the industry, you was at the heart of it in New York City and Wall Street. You're definitely a great mentor, and with that little salt and pepper on the side of your head to let us young millennials know, like, hey, listen, this is how things are kind of this. I've seen this before. And I've seen the stories where it says, hey, smart man learn from his mistakes, a wise man learn from the mistakes of others. So I definitely want to appreciate you for coming on.
Wonderful. Well, thank you very much. It's always great to be on. You have great listeners, and your show and all the stuff you do is fantastic. It really is.
Oh, thank you. Thank you. Appreciate it, James. Until the next time.
All right. Have a good night.
All right, you too. Once again, ladies and gentlemen, boys and girls, and children of all ages, this is the Investor Show. That was James Foytlin. We talked about are we facing to another recession? Thank you guys and girls for tuning in. Until next video, podcast, cartoon, whatever else you see me new crazy around the globe. Peace, be safe. I'm out, and thank you.